Space stocks are going to the moon, and that's not a good thing at all. Why are space stocks soaring? Nobody ever asks that question because they expect their stocks to go to the moon. That's what stonks do, right? They always go up. No, they don't. Volatility goes both ways. All the 25-year-old life coaches out there say that Wall Street's just now discovering their sacred cow. We're here to tell you that's not the case, and we'll show you why. If you're invested in names like Intuitive Machines, Rocket Lab, or AST SpaceMobile, then you're going to want to watch this video. Now, the first thing that we need to do is establish a universe of space stocks. In order to do that, we've opened up our tech stock catalog, which covers over 460 tech stocks available for all annual premium subscribers. And we filtered on the SPAC flag so that we can isolate all space SPACs. Today we'll focus on space SPACs only, and we'll start with one that's recently disappeared. So when we update this catalog every month, for our next update, we'll remove Astra Space. And you see here the last time we covered them several years ago, we asked the question, is Astra Space ready to launch real revenues? What do we mean by real revenues? Well, we consider real revenues or meaningful revenues to be $10 million per annum or higher. So Astra, to avoid bankruptcy, recently took their company private, and as a result, investors lost 95% of the value of the shares they might have bought when the SPAC debuted. So just one of many, many examples of SPACs screwing retail investors. Another great one is Momentous. So we wrote about them, 4 years ago, coming up on 4 years. We said that the founder had a dubious track record, and shortly after publishing this piece, I received a call from somebody that confirmed a lot of our suspicions that they're now under $10 million market cap. They've lost 99.9% of their value since we warned investors about this firm. Recently, the directors and officers are coming together to loan the firm $500,000. That they're just in survival mode at the moment. It's very important. Always avoid companies with no meaningful revenues. As I said, we define that as $10 million per annum or more. Now, another company that has lots of broken promises, similar to Momentous and the $1.2 billion they said they'd be bringing in this year, is Terran Orbital. They also projected close to $1 billion in revenues this year. Well, they recently had an exit as well. So as we pointed out in a previous piece, Lockheed accounted for 76% of the revenues in 2022, more than 80% of their backlog. And guess who's purchasing them? Lockheed Martin. Why? Well, because they were essentially subsidizing Lockheed Martin. Look at the bottom there. Does that table look familiar? It's a firm that has pretty much negative gross margins, so they fluctuate between positive and negative. So this is very important to point out. Look at the chart on the right. You see the nice growing revenue stream? We like that. You see losses? That's okay, because if you're a disruptive tech firm, then you're burning through a lot of money trying to grow revenues. That's fine. But what's not excusable is if you have a gross margin that's negative or barely positive. And we said here, this was 3 years ago, the company's reliance on government work through NASA and the Department of Defense is something we generally avoid. That's regulatory and government risk. We said we didn't have much confidence in the firm because about half their business had yet to take off. And it's down 97% since we said to avoid that stock. This is very important to note when we're talking about space companies. This particular article here, it says defense firms growing warier of fixed price deals. Now, under these agreements, they're meant to secure the least amount of risk for taxpayers. That's good. But companies pick up the bill when costs run higher than expected, and a lot of defense firms are now backing away from these fixed price deals. For example, Boeing's $7 billion in cost overruns on a $5 billion contract. That's very problematic. Raytheon told investors recently that legacy fixed price programs are weighing down the company's profits more than rising material costs and suppliers falling short. So some takeaways here that are very important. Defense firms are going to be more selective when they consider fixed price contracts. What that means is smaller firms can score easier wins and then laud these to their investors as spectacular traction. Now, this is why we believe revenues are always ground truth, not bookings, because as those revenues progress, you can then watch to make sure gross margins stay consistent. Never invest in companies unless they have revenues, and if they do, make sure that they have a consistently positive gross margin. Now, Another company, a space SPAC we warned investors about twice. First time here you can see when we warned right there at the top. That was clearly hype, right? And look at the hype based on their SPAC debut, so it was up 8 times off the SPAC price. And now it was hyped again recently with the moon landing and our last piece on this firm, Lunar. We covered why is this space stock up 265% this month. Well, it's down 43% since our last piece, but it's up 33% in the past 5 days. Why? Well, we're going to talk about that, but first, does this table along the bottom there look familiar? Look, that's a firm in last year. They had cost of goods sold. This is a firm that had negative gross margins last year. We're just not interested. And in this last piece, we said their margins, of course, show us there isn't a big potential for profit. The next administration, are they going to think that Artemis is a high priority as well? So if you're doing projects that involve something like landing on the moon again, NASA is your majority customer, then what happens if there's an administration change in the States? Will that affect your contracts? Maybe it will, maybe it won't. But what are the opportunity costs here? This isn't an overly profitable venture, and if you really want to invest in this company, we said wait until the moon dust settles, and that was certainly correct. Now, I wanted to point to this interesting table here that we came across, this aptly named site, Ape Wisdom, and it looks at the interest on Wall Street bets for particular companies. Now, stocks of a feather tend to move together. What do we see there in third, fourth, and fifth position? We see all three space stocks that appear to be rising recently for reasons that are evident here. And of course, as I said, people will say, well, Wall Street's just discovering my genius stock pick. Well, that's not the case. In the past 2 weeks, you see here, Rocket Lab up over 50%, ASTS over 70%, Lunar up 50%. Experienced investors know what's going on here, and you'll see these speculators out there pointing to the next stock that's going to join them potentially. Whether that happens or not, we don't care. We invest in companies, not stocks. But we've seen lots of similar hype cycles in the decades that we've been doing this. When stocks of a feather move together, it usually indicates hype. We've seen this with 3D printing stocks, graphene stocks, gene editing stocks, to name a few. Of course, AI stocks, right? We see that with those as well. Now, these themes aren't connected by the GICS industry classification standard, so it's rather easy to spot this hype, and of course they come with pretenders. Now, before we talk about ASTS, a short message from Wyatt.
One company we happen to like isn't being discussed today. It's up 82% since we last covered it, saying we preferred them to Rocket Lab. Is that still the case? Well, we're going to be covering that stock soon in our free newsletters, so definitely sign up. It's free, and the worst thing that can happen is you'll become a better investor as a result. We'll put a link to sign up below.
Thanks, Wyatt. So let's talk about ASTS. They cleared $10 billion market cap with no revenues. That's just unbelievable. Typical pump and dump behavior on exhibit. The story is still the same. It hasn't changed for us since the last time we looked at this firm several years ago. So let's revisit. Here's how it started, right? They promised investors all these great things. They're going to be the next Starlink. Well, the next Starlink is Starlink, but they said they're going to have 44 million subscribers this year, over $1 billion in revenues this year. Last year, they were supposed to launch their commercial service across 49 countries. So how it's going? Well, they were slated to launch 5 satellites. Now, I want to point out here, SpaceX, who's launching their 5 satellites, which have yet to be launched, has over 6,000 functional satellites in space right now for Starlink. So ASTS is a bit behind. Their launch in 2023 slipped until July or August of this year, and then it slipped again. They said that was because of 2 suppliers that ran into problems, and now their planned launch is supposed to happen in the first half of September. Now, this is all noise. Just how far away from revenues is AST SpaceMobile? Again, going back to that point we've been making over and over about not investing in companies unless they have revenues. Well, if SpaceX is any indicator, then ASTS has quite a way to go. So you see here the FCC is going to let SpaceX expand testing of cellular Starlink for phones, so they can now test this in California, Texas, and Hawaii statewide. So SpaceX and the 500-pound South African gorilla in the room are certainly in a lot better position right now than AST SpaceMobile to begin offering cellular service via satellites. And One of the problems you have with ASTS is the mob of Muppets out there that pump this thing left and right without a thread of common sense in the majority of them. Usually this A symbol that you see in somebody's social media profile has a high predictive value. It says that when they open their mouth, their brains are going to fall out. Investing in a single company and then establishing a community around it and cheerleading it to death does nobody any favors. So even if they genuinely believe in what they're saying, and I don't think that's the case, I think a lot of them are just running a pump and dump. Even if you genuinely believe in a stock, you would never, for any company, take on such risks. And if you did, you would want to be discussing potential problems with that. That's a dead giveaway. Because if the stocks you're most bullish about, those are the ones you should be the most critical about because you have the most at stake. The same holds true for the Rocket Lab zealots, of which there are many. Rocket Lab is up 45% since this piece. That's not a good thing because intrinsic value doesn't appreciate that rapidly, as we talked about earlier in the case of hype. What Rocket Lab needs to do, this is very important, they need to nail that reusability component or they're not going to be able to compete on price. That's very important. We have concerns around their recent contract award, and here I've put up this table, and this is their gross margin over time. So they used to have a negative gross margin or barely positive, and you see that consistent rise. That's why we went from avoiding Rocket Lab to liking it, because they were able to show that they can run a potentially a profitable business, and we'll revisit this firm about once a year. But I wanted to point to something here that's worth noting. So they had a presentation, talks about the largest contract in Rocket Lab history. And look at that, I've highlighted a fixed price. And here on the left, you see somebody asking this question, why isn't Rocket Lab going up with the market and with this big new contract? Well, because it's fixed price. And I see lots of RKLB is going to be a $20 stock next year types out there. And I didn't see any of them point to this potential problem. This is why it's very important to invest in companies, not stocks, right? So when a stock price goes up rapidly, that's not a good thing for investors. It maybe is good for speculators, but it's not good for investors. Now, unless there's, of course, you can point to a tangible reason why intrinsic value appreciated. Now, let's talk about Planet Labs. And we check in with companies once a year. I find that at a quarterly level, there's a lot of noise and can be difficult to identify problems, whereas when you're looking at firms at an annual basis, the problems come at you quite quick. Here you can see several years ago, we pointed to Planet Labs' competency and growth, and then look at our most recent piece this year, inaccurate forecasting and slowing growth. So some problems there, and you can read this article and dig into our analysis there. But I wanted to just look at the three geospatial intelligence providers out there, the pure plays, Planet Labs, BlackSky, and Spire. What you won't see in this list is Satellogic. They're sub $100 million, and we just don't cover companies that small. That's because small companies can get in trouble fast. So I think our cutoff somewhere around $250 million. And I think Spire is a good example of what can happen here. So they recently told the SEC they're going to have a delay in filing their 10Q. They said they're in the process of reviewing their accounting practices. Not a good thing. They say with respect to revenue recognition, that's even worse. And the company may be required to restate. So that alone is problematic. But then look at this next section. They say the company believes that it may not be in compliance with a debt covenant. Oops, that's a big problem. And when you look at Spire, and I did recently, prior to this problem rearing its ugly head, they have nice revenue growth, of course. Gross margins appear healthy. But again, they're way too small to be on our radar, and small companies can get into trouble very quickly. That brings us to our next name, Redwire. And in our last piece on Redwire, I believe it was earlier this year, we said that revenues have been continuously bolted on for the last 3.5 years, so it's tough to really wait for all that to settle so we can get an idea of what their core competencies are and what organic growth looks like. And when it comes to liquidity here, they point to this $56 million in liquidity, and that's broken down between borrowing capacity and cash. Of course, they don't appear to be burning a ton of cash there, but they're not sitting as pretty as a lot of other space companies when it comes to the cash stockpile that they realized from their SPAC debut. And when we look at gross margins, we see volatility, and that's really not a good thing. As I said, we want to see consistency, ideally a trend that's moving upwards. Now, when it comes to Virgin Galactic, at its peak, it traded at over $1,000 a share. Now, they, of course, like many SPACs, have reverse split so they can stay listed. But if you bought shares at the peak, you'd be holding bags that are now down 99%. So this is a sub-$200 million market cap company. They say their Delta-class spaceships are on track for commercial service in 2026. Cool. So in a couple years, they're going to start doing what they said in their SPAC deck they would probably be already doing. Let's repeat this mantra. No meaningful revenues, negative gross margins, zero interest. All right, so you can see that table there for Virgin Galactic. Now, we warned investors on SPACs in 2020. We've since covered over 100 of them. We said that at some point the Robin Hood types would start pumping up the price of SPACs. Of course, they've been doing that ever since. At some point, we said the red-hot SPAC market is going to have a reckoning, and indeed it did. The only losers in this story, of course, are retail investors, is always the case, right? Democratizing access to IPOs, Chama said. Well, that didn't really work out, did it? The irrationality, we said, of weekend warriors is far greater than your margin account limits. And this table along the bottom just emphasizes how you need to be very careful about stories and projections. So this is what Virgin Galactic was expecting last year, $590 million. Well, we see how that's going. So some parting thoughts here. Space and cannabis are the two riskiest themes we cover. Why do you want exposure to space exactly? And there's certainly a fair number of reasons. You know, lots of satellites will be launched and different offerings in space. We may be going to the moon, populating Mars and all that. Space, the final frontier, right? It's very understandable for many retail investors, but there's a lot of risk there. And as I said, when you're looking at these firms, no revenues, no interest, no exceptions, and hype is always going to create bag holders. It's as predictable as the sun coming up every morning. Invest in companies, not stocks, and pay little attention to the volatility that surrounds hype. And we invest in leaders. Who's the leader right now? Well, SpaceX. They're absolutely crushing it. And if you want to invest in SpaceX, you need to be very careful. We published a piece on a firm called DXYZ, which offers a meaningful amount of exposure to SpaceX at a price. I suggest you watch that next. It's rather interesting. Thanks so much for taking the time to watch this today.